Kia ora koutou. Welcome to Shared Lunch, brought to you by Sharesies with BusinessDesk. Sharesies is a wealth development platform whose purpose is to create financial empowerment for everyone. My name is Dan Brunskill. I'm the markets reporter at BusinessDesk. We're a news outlet, if you didn't know. We actually have a special offer for Sharesies investors. If you use the promo code SharedLunch100, you get $100 off an annual subscription to BusinessDesk, which is usually $249, including GST. The offer only applies to new BusinessDesk subscribers and can only be used once per subscriber and can't be used with any other discounts. Okay, before we get started, here's some important information from Sharesies.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Also, just as a quick reminder, if you have any questions for our guest, you should submit them through the Ask a Question button, which should be down the bottom of the screen somewhere. Don't put your questions in the discussion area, as I won't be looking at that and will likely miss them. So put them in the Ask a Question. We'll get to all your questions. If we have lots of questions, we'll go to questions early. We love to get those questions through to our guests because that's what we're here for. Speaking of our guest, please be kind and respectful, both to our guest and fellow viewers. Otherwise, we will remove you from the webinar. Today, our guest is Miles Workman. He's a senior economist at ANZ Bank. Welcome, Miles.
Yeah, hi. Thanks for having me.
It's great to have you. I was commenting earlier on how great your name is as a bank economist, Miles Workman. I was saying that it's like what a bank economist would be called in a James Bond film.
Oh, that's a pretty good compliment. I think it's more of a tradesman's type name, but I'll take the win there.
It's good. Thanks for joining us. Hey, we're keen to have a deep dive into the economy, talk about what's going on, because it feels to me like we're in a fairly unusual economic moment in history. Things are very different to how they have been and feel a little bit unpredictable. I don't know if it feels that way to you, who watch it all the time. How do you feel in that regard?
This is probably a once in a lifetime scenario we find ourselves in. The economy since the pandemic has been extremely wonky. What I mean by that is we've basically shut off entire industries, international tourism being one of them, injected copious amounts of economic stimulus into the economy via both fiscal and monetary settings. That's supercharged the domestic impulse, so things like construction, private consumption, that kind of thing, creating even further divergence between the haves and the have-nots, I suppose you could say, or the winners and the losers in this post-pandemic environment. So it is very wonky and more wonky than I think the GFC in that regard.
Yeah. We're sort of having this odd pandemic. Basically, we had a pandemic economic boom, which is basically the opposite of what is supposed to happen, and we're seeing some of that unwind now.
Yeah, definitely. Yeah. I think we have to categorize this crisis as it was misdiagnosed initially. I think we all looked into this thing at the very beginning. We were looking at oil prices, which picked up a negative handle in terms of trading. People were paying to get rid of their oil contracts. We saw confidence tank. This is right at the beginning of the pandemic, of course. And I think economists the world over misdiagnosed that as ultimately leading to a net demand shock. We thought those confidence channels were going to be a lot more reinforcing. But what we've found out with hindsight is that the supply side of the economy was probably on balance shocked a little bit more than the demand side of the economy.
Yeah.
And that's led to this inflationary environment that we find ourselves in while we're still sort of quite cautious about this looming slowdown.
Yeah. Okay, that's a great place to start, because what happened yesterday is the Reserve Bank chose to raise its official cash rate, which is kind of the base rate that all other interest rates are built upon. And they also raised their forecast on how high they expect that official cash rate to go, almost to 4%. Can you talk about why the Reserve Bank is doing this and what it is trying to achieve by raising interest rates?
Yeah, it's a good question. Ultimately, the Reserve Bank is tasked with maintaining stable inflation around its target, which the midpoint of that target is 2% over the medium term, of course, and maintaining full employment. If a central bank loses credibility on being able to do that, there's a very significant risk that further down the track, you get this wage price spiral. So ultimately, you end up in this more, well, I wouldn't want to call it hyperinflation, but extremely prolonged and elevated
Mm-hmm.
inflation, which does not it's very hard to sort of pat on the head once it gets going. You can think of it as a rock
Hard to
falling
stop.
down a hill. The more momentum it gets, the harder it is for the Reserve Bank to achieve. And in fact, if the Reserve Bank
Mm-hmm.
doesn't get onto it quick and quite aggressively with front-loaded aggressive hikes, there's actually a risk that underlying inflation pressures continue to build over the outlook,
Mm-hmm.
therefore necessitating even larger outsized OCR hikes further down the track.
Mm-hmm.
So in a way, you can think about what the Reserve Bank's doing now as tough love. I think they're trying to stomp out inflation, pat that down before it gets out of control for too long. And fingers crossed, by being front loaded with 50 basis point hikes, they normally hike in 25 basis point
Mm-hmm.
increments. They can hopefully alleviate those inflation risks. Ultimately, that's what the Reserve Bank's doing. That they've got on a big risk on one hand, which
Mm-hmm.
is inflation gets out of control for a long period of time. The big risk, on the other hand, is that they induce a recession or a hard landing in the economy. Every monetary policy decision from now, until over the next few years, it's going to be the Reserve Bank weighing up those risks. Which risk is
Yeah.
greater? Which one do we have to respond to first? But it is very much a
Yeah.
rock and a hard place scenario.
Yeah, I'm interested to get into those twin risks. But before we do, can you talk about what a wage spiral is, or inflationary pressures in multiple directions, and can you also tell us how interest rates slow down the economy, or sort of do anything about inflation? They seem quite disconnected.
Sure. So the wage price spiral is the big risk, I guess, on the front of everybody's or every economist's minds, at least.
Mm-hmm.
Ultimately, this is a scenario where you get a bit of high inflation, maybe a supply shock, or maybe a very tight labour market, boosting domestic inflation, which is what we're seeing in New Zealand. But ultimately, if you allow that to occur for too long, both businesses and households start adjusting their expectations for inflation, and that impacts their price setting and wage negotiating behavior. So essentially,
Mm-hmm.
via this expectations channel, high inflation becomes self-fulfilling and it starts to feed high inflation. And once that spiral gets going, it gets
Mm-hmm.
embedded into wage negotiations, it gets embedded into how firms set prices, it keeps feeding itself, ultimately making the Reserve Bank's job tougher and tougher as that continues to evolve.
Mm-hmm.
So that's the wage price spiral. If it does occur, you can think about it as, maybe households are happy because they're getting solid wage growth, but that's
Yeah.
nominal wage growth.
Mm-hmm.
At the same time, inflation's really strong, and in inflation adjusted terms, many households will be going backwards or in fact
Okay.
stagnating. So
Yeah.
that's really what the Reserve Bank's trying to avoid there. In terms
Mm-hmm.
of how interest rates will slow the economy, you can basically think about this in terms of what does it do to decisions made by households and businesses, right? A higher interest cost
Okay.
on their borrowing essentially means less demand for that borrowing. It's the housing
Okay.
market is going to face a significant headwind. It's going to slow down housing.
Yeah.
Slowing down housing is going to reduce households' discretionary sort of spending. So that's things on big ticket items, washing machines, sports cars, jet skis. That's going to be sort of some of the first parts. And as that higher interest burden on households and that higher inflation burden too really begins
Mm-hmm.
to really begins to weigh, I should say,
Yeah. Yeah.
you really do see households entering a period of belt tightening, and that slows the economy quite significantly. So, in a way, it's a double-edged sword right now for households because
Mm-hmm.
you've got high inflation hurting them, and you've got rising interest rates hurting them. So it is definitely tough love, but it is kind of necessary to
Yeah.
to sort of bonk those longer term implications on the head.
I think the big example I've seen about how interest rates slow the economy, or pull money out of the economy, is that anyone who has a home mortgage, their mortgage rate and their interest repayments will be going up, and more of their salary will be directed towards paying their mortgage interest, and less of it will be directed towards buying goods and services in the economy. Is that one of the ways that the higher OCR slows down the economy?
Most certainly. You can think
Yeah.
about it as a balance sheet. Every household has its own balance sheet. They have income coming in from the work that they do or the assets that they own. They have outgoings, which includes taxes, but also keeping the lights on, keeping the heater running, feeding, putting food in the bellies. When you take all that out and you start increasing the interest costs on top of that, you are left with a smaller residual at the end of the day, and that smaller residual therefore starts to impact decisions.
Yeah, less money to spend, less money chasing the same amount of goods.
Yeah, exactly.
Yeah. All right. Interesting. So obviously, interest rates are going up so that the Reserve Bank can tamp down inflation. Can you talk a little bit about exactly why we are experiencing inflation? I think that the textbook explanation that people have in our heads is like when you print money, inflation occurs. But it seems like there's slightly more to it. This is sort of driven by partly a supply side shock, partly by monetary policy, partly, which is, central bank policy, partly by government spending. Can you talk us about the factors that have led to inflation and which ones are the bigger ones?
Sure. Well, let's start with the big picture. Okay, so
Mhm.
ultimately, you have all these resources in the economy. So that's the number of people who can supply labor. You have the amount of capital stock in the economy. So that's all the machines and things that those people use. And you put those two things together, add a sprinkle of technology. Turning the existing capital stock into, productive gains essentially. But those three ingredients,
Mhm.
so productivity or technological advancement, capital, and labor, you take those three ingredients, and that can basically give you this potential level of output in the economy. What's happened under COVID is that potential level of output has actually fallen because we cannot import labor from overseas. People mobility, so people are probably a little bit more reluctant to work. We're really seeing that in the US right now, where their labor
Yeah.
market is seeing people not willing to participate at the same level as prior. So you can think about that as a supply shock.
Mhm.
So we've had that happen at the same time that both fiscal and monetary policy has been very effective at stimulating demand. So we're in a situation
Okay.
right now where demand is exceeding supply, and when that happens, you get inflation. So essentially, what the Reserve Bank wants to do is get those things in balance. They can't really control the supply side of the economy with interest rates, but they can control the demand side.
Yeah.
So the Reserve Bank inherits the supply side of the economy and then tries to set monetary policy to bring demand in line with that. So that's the broad
Okay.
economic sort of story, and that's pretty much happening
Mhm.
the world over. The details of what's driving it, there are multiple forces here, which
Mhm.
some of them are supply and demand shocks, some of them are just demand shocks. But ultimately, we've got global forces and domestic forces. So the global forces, the big ones right now, are very high commodity prices, but they are coming off their peak. So it's things like oil prices.
Okay.
That's been impacted by the
Milk
war in
powder.
Ukraine. Milk powders following
Mm.
those global commodity prices again starting to come off, but still at a high level overall. So that stuff's all inflationary. Then you look at the domestic factors. Look, the big one is our very, very tight labour market. We have an unemployment rate at 3.2%. It's
Mhm.
basically a record low in terms of the current data we look at. If you look at other indicators of labour market tightness, so a really good one here is maybe the ratio of job ads, so people looking for workers,
Okay. Mhm.
versus the number of people who are currently unemployed. If I was to show you a chart of that, it would be basically off the off the charts. It's really shot up in this post-pandemic world because we've had a supply shock. Firms can't advertise for overseas workers, so they're having to compete more heavily for domestic workers. And B, we've had
Mhm.
lots and lots of demand, basically meaning they want to hire more people in a constrained supply environment. That is really the big story, I think, under core inflation, under domestic inflation pressures. That's the side of the equation that the Reserve Bank probably cares the most about. Global
Mhm.
forces go up and down, up and down, up and down. But
Yeah.
once those domestic inflationary forces get going, they can be really hard to slow. And in fact, sometimes you can only slow it by causing the labour market to loosen up a bit, i.e., a higher
Right.
unemployment rate.
Yeah. 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 So okay. So just to summarize, the pandemic meant there was less resources in the economy. Government and central banks stimulated the economy, created demand. Those two things have led to what is now a sort of a 40-year high in inflation.
That's exactly right. And looking forward, those two things are now going to unwind. So what we're going to see as we get further and further away from ground zero of the pandemic is we're going to see the supply side of the global economy gradually recover, fingers
Yeah.
crossed. And we're going to see the demand side of the economy slowly fall as that monetary stimulus is withdrawn. So those two
Interesting.
things together, you can say, yep, hopefully the medium-term inflation outlook is an easing.
It's interesting to hear you say demand will slightly fall, because it seems to me that what the Reserve Bank is trying to do is push demand down quite a lot, which to me and to many people suggests there's like a relative risk of induced recession, basically causing the economy to contract. I mean, it essentially has to, right, to match supply. Is the Reserve Bank trying to cause a recession, and could they do so?
They could definitely do so. We're
Okay.
not forecasting that they will. They're not forecasting that they will. But that is nonetheless a risk that they have to be willing to take right now. Because as I mentioned earlier, if they don't get on top of this inflation spiral, they're going to have to be even more aggressive later down the track, which is going to be even greater odds of a recession and likely a deeper than otherwise recession. So again, it's that tough love story. There are certainly indicators we're monitoring right now, such as, or actually our ANZ Roy Morgan Consumer Confidence Survey. It's got a really good question in there. It asks households, is now a good time to buy a major household item? That generally follows retail trade pretty closely. It hasn't recently because retail trade is volatile because of COVID, but that survey is consistent right now with recessionary levels of consumer spending. Now, the
Okay.
consumer in New Zealand, it's about 60% of the economy. So,
Okay.
some pretty significant red flashing lights. I would say
Yeah.
we are probably closer to those recession risks than we've been in a long time.
Yeah. So you're not forecasting a recession, but you are saying there's a relatively high risk of one?
That risk is higher now probably than it's been in quite some time. Obviously, if you asked me the same question as the pandemic was first sort of arriving on New Zealand shores, we did enter a technical recession at that point. But if we just look through the COVID noise and we just think about this more from a sort of business cycle perspective, I think what
Yeah.
we saw with COVID is it didn't actually stop the business cycle. It just caused a lot of
Okay.
noise in the business cycle.
Yeah.
But we are now at that point in the business cycle where a recession is a lot more likely than it's been in probably, since the GFC in terms of an
Okay.
underlying fundamental recession.
Yeah, yeah, yeah. It was really interesting covering a lot of company earnings during the pandemic, because everyone's earnings plummeted, but then you often found that the quarter after lockdown or whatever, it suddenly came all the way back up to where it would have been had it just continued in a straight line, or often more, because of the fiscal and monetary stimulus, or all the money that was being pumped into the economy. It was a really interesting time to watch, and it feels like we kind of bridged or jumped over what should have been a pandemic slowdown, and maybe that's coming back around to bite us a little bit now.
Yeah, well, I think you can say, with the benefit of hindsight, that stimulus was too much stimulus.
Yeah.
I mean, we were calling a negative OCR at one stage because, again,
Mm.
all those indicators were pointing to a significant and prolonged economic contraction. I mean, a person on the street can sit on the sidelines and say, "Look how terribly bad economists' forecasted this crisis," and I'll, quite
Hmm.
freely admit that we all got it wrong. But ultimately, it is one of those things where the world has changed just so significantly. Our understanding of this crisis has improved so much over the past couple of years as it's evolved, and now we are in this sort of tricky situation where we've got recession risks, but we've also got high inflation risks.
Hmm. It's we are sort of on an investment podcast, and I don't want to ask you to give any investment advice, but generally, if we were to head towards an economic slowdown or even recession, what sort of impact does that have on investments? I assume it's not good.
Yes, well, the relationship between interest rates and say equities is obviously quite clearly an inverse one, and what I mean by
Hmm.
that is interest rates or high interest rates and business profits, they are not good friends. So you
Hmm.
can watch this in global markets with the S&P 500. When the Federal Reserve comes out with a relatively hawkish message, you can almost guarantee that global assets are going to take that in a negative light, suggesting, well, they're going to dampen down demand, they're going to increase costs on businesses. That's not good for their bottom line, therefore it's not good for the share price. So you do see that dynamic play out quite a lot. But I think the other thing to consider is we're not only going into a world of higher interest rates now, we're also going into a world of probably more volatile financial markets, more volatile interest rates. 50 basis point hikes is a perfect example of that. That's something that just maybe a year ago we wouldn't even be thinking about. It wouldn't be on our radar. Now, we're looking at maybe 3 or even more possibly consecutive 50 basis point hikes by the RBNZ. That's volatility right there. And again, businesses and bottom lines, they do not get on well with volatility in financial markets. So I think, we are looking at choppy seas ahead, that's for sure. Hopefully, fingers crossed, policymakers are relatively successful in engineering a soft landing and limiting sort of how much fallout there is. But there are scenarios out there where the landing is harder than everyone expects, or it needs to be harder than everyone expects to get inflation down, and that could be much more significant for equities and share values.
Yeah, so that's interesting in terms of the soft landing, which the RBNZ and indeed the US Federal Reserve is trying to do. And part of the reason why equities have been falling so much, as you say, is because central banks have very suddenly decided they have to hike interest rates quite high to stamp out inflation. People were quite surprised yesterday that our own central bank said it would consider raising rates almost to 4%. That to me seems like the sort of level where some mortgage holders might start to get in trouble. We're sort of heading towards more of a hard landing if we're going up to 4%. But I've seen a lot of economists say that they sort of think the Reserve Bank is saying we're willing to go that high, but many think they won't have to because the economy will slow down before it gets that high. I guess double-pointed question here: how much trouble would mortgage holders be in if the official cash rate went to 4%, and how likely do you think it is that it will go all the way?
Okay, well, they're very good questions because our forecast is actually for the OCR to peak at 3.5%.
Okay.
We're not ruling out a 4% OCR, but our forecast is for 3.5, and we basically expect the Reserve Bank to start moving in 25 basis point increments from August. Essentially, that view reflects our expectation that some of the inflation data, some of the labour market data, it's going to show some signs by then that monetary tightening is actually getting a bit of traction. So the things that we're really monitoring there will be our consumer confidence survey, inflation expectations within that. Same with our ANZ Business Outlook survey, expectations of inflation within that. So those things alongside the labour market indicators will hopefully, come August, have the Reserve Bank start to reassess the balance of risks between a hard landing and inflation, and in fact at that point may decide to start hiking in a more gradual fashion. In terms of what does this mean for mortgages, and are we already in the hard landing scenario? Look, that is a possibility. That's well within the realms of momentum, say in the housing market. In terms of the most vulnerable, of course, it's going to be anyone who's just recently bought a house at obviously a very high price and had to borrow a lot of money for that. They probably weren't expecting to face mortgage rates where they currently sit. So, we've got about 60% of total mortgages on the books and across all the banks in New Zealand that are either floating right now or coming up to be refixed in the next year.
60%.
60%. So that suggests, interest rates for those 60% could well double. And that's a significant bump, I think, in sort of their bottom line. So as that bites, that's kind of a good example, actually, of how monetary policy acts with a lag. That typical lag is, the Reserve Bank moves the OCR today, wholesale markets adjust, people refix their loans. The peak impacts of that are generally sort of 12, 18 months down the track. And if you step back and go, well, when did the Reserve Bank start removing stimulus and start tightening financial market conditions? Well, that was in mid-2021. So we're only starting to see those early impacts now, and those impacts still have a bit of time to flow through and could very well be larger than most economists are assuming.
Yeah. Okay. So definitely, definitely some risk of recession. You said there were a bunch of indicators there. You were watching things like consumer confidence, inflation expectations. Can you very broadly characterize what they look like? Are they looking negative?
Well, in terms of inflation expectations, a lot of these indicators are at worryingly high levels. And just like our actual CPI data, our actual inflation data, that's almost 7% in the last read. We hope that's around about the peak and it should start easing soon. But a lot of those indicators on the inflation side are very, very worrying right now. They are still sort of trending upwards and it's a very, very sharp increase. On the activity side of the equation, things are starting to soften. So that's like the consumer, telling us that it's not a good time to buy a major household item. It's also the business saying, well, maybe I don't want to invest as much as I was planning on, this time last year. Those types of indicators on the activity side are still deteriorating. The
Yeah.
indicators on the inflation side are remaining quite high and at worrying levels.
Okay.
So these are sort of indicators in the economy where we're hoping to see a turning point,
Yeah.
and
Yeah.
hopefully see a turning point by August, which will have the Reserve Bank take its foot off the accelerator a little bit,
Okay.
in terms of these OCR hikes
Yeah.
that are in train.
Miles, we've talked about this as being sort of opposing risks, the risk of inflation or the risk of recession. But then you're sort of saying that consumer confidence is falling, people don't want to buy goods, but inflation expectations are staying high. Is there a scenario where we both have growth slow down and inflation continue?
Yes, and
Oh,
that's
goodness.
the scary that's the that's the scariest scenario of them all.
Yeah.
So we'd call that stagflation. And we saw that in the 1970s.
Hmm.
Lots of elements were contributing to that: oil prices, demographic change, even some regulation in labour markets that put a bit of a floor under wage rates, which meant wages were not reflecting market fundamentals. There was basically a lot of labour supply injected to an economy that was facing positive shocks to inflation via oil prices. And that was a nasty, nasty combination because it meant that unemployment lifted, it meant economic
Yeah.
growth fell, but inflation remained high. Now, I would say there's a lot less risk of that happening now because I can clearly see by looking at asset prices and even confidence indicators that monetary policy is
Okay.
working. We just need to give monetary policy time to do its thing. As I mentioned, there's a 12 to 18-month lag. So if you think about that transmission mechanism, you've got confidence and asset prices will be hit first. That will start to
Yeah.
impact activity, so construction, maybe spending, and that will eventually start to impact inflation, but with that lag. The risk here of the high inflation, weak growth, high unemployment scenario is that the Reserve Bank and other central banks around the world are not successful when it comes to taming inflation
Hmm.
expectations. And that's that spiral I was talking about earlier.
Okay.
If that's allowed to go and go and go and go, then the Reserve Bank has to be even more aggressive. They're going to have to engineer a higher, a harder landing for the economy. So that's higher unemployment, weaker growth, while still getting on top of high inflation. And
Yeah.
that's why the Reserve Bank are being quite aggressive now.
Okay, interesting. And in the event of the one of the more likely scenarios, which would just be like a small contraction, the soft landing that we're talking about, not a full-on recession, but just sort of a soft contraction to bring demand and supply more in line. Our best case scenario, still, what does that look like? It still means higher unemployment, doesn't it? It still might mean lower earnings for consumer driven companies. It still means maybe slightly lower house prices. Is that sort of picture where the sort of even the what I'm trying to say is even the best case scenario is sort of a less hot economy than we have now?
Oh, 100%. And I think there's a very good distinction to make here between what's the absolute
Hmm.
story and what's the relative story. Because if we think about things from a relative perspective, we've seen house price inflation sort of in an annual sense peak at 30% year on year late last year,
Yeah,
a
out of
40%
control.
increase from the pre pandemic level. That's unsustainable, which simply is unsustainable. If you look at house prices relative to
Hmm.
incomes, you just can't do
Yeah,
that forever. You can't do that for very long at all, in fact.
yeah.
So from that sort of growth and relative perspective, there's absolutely no way that the economy over the next couple of years is going to feel as rosy as it did. It almost felt bulletproof,
Hmm.
over most of 2021. Confidence was just, high generally amongst consumers. They were certainly spending it, and businesses were happy to accommodate that. In an absolute sense, which is a little bit different to the relative story, I think some perspective is required. For example, we're forecasting around about a 10% fall in house prices this year, right? That's not a good relative story, but in an absolute sense, that would still leave house prices 30% above their pre-pandemic level. So it's very much a soft landing. Ultimately, we have a very, very low unemployment rate. People out there who want to work can work. It's just that their income growth right now isn't keeping up with inflation, so they feel like they're going backwards. But that's a much better story in an absolute sense than people losing their jobs. Right. So there probably will be a little bit of pain in terms of people losing their job and in terms of employment growth over the forecast horizon. But we're not talking about an aggregated, or at least on our central forecasts, an aggregated employment or income shock. Good distinctions. So I think to summarize that, it's the economy is going to feel very different in 2022 by the end of the year than it did over 2021. But in an absolute sense, it's still, hopefully, all fingers crossed, all fingers and toes, it's not too bad.
Okay, interesting. It's funny. It's sort of, to my mind, it's an objectively good thing to have such low unemployment. I love that. That's like really good. But it is really interesting when you're out in the economy, you can sense that there aren't enough workers. Like I got stuck in an airport line while with not just on my own because I was running late, but about half my flight was stuck because there just weren't enough security guards doing the baggage check. And I was in a McDonald's in Wellington, don't ask why, and they literally locked the front doors of the shop because they only had 2 staff on and it was about to be the breakfast rush, and they were like, we just can't do it with 2 staff. So they locked the front door, served us customers that were inside, and then evacuated us on a service route, being like, we just don't have enough staff to handle the breakfast rush, so we're going to close for 2 hours. It was just like a fascinating example of what it means to not have enough workers in an economy.
Yeah, I mean, there are some really, I suppose, bonkers anecdote out there about these types of labour shortages. And as an economist, we do run that risk of saying the unemployment rate's too low, and it makes us look like a bad guy, right? It makes us look like we're just saying, politicians are the opposite. Look how amazing the unemployment rate is right now. Look how good a job we've done. But the big picture, or the macroeconomic cycle perspective on the labour market, is that if you overheat the labour market today, it's more likely to go through those recessionary dynamics tomorrow. Therefore, you have way more volatility in the labour market, and over the longer run, that total cost of running things too hot for too long is actually larger than trying to maintain a labour market which is more consistent with its sustainable level. And that is why the Reserve Bank are actually tasked to target employment at its sustainable level. They're trying to avoid these cycles, which ultimately, if it's too hot today, chances are it's going to be a bit of a sharper than otherwise and painful downturn tomorrow.
You don't want to have 3 brilliant years and then 10 terrible years. You want to have 5 good years and 1 slower year. That's sort of the idea.
Exactly. There's this concept of economic scarring, and when you go through something like the GFC, I'll use that as an example because it's a much better example of a slowdown than the pandemic experience to date. You go through a period like that of higher unemployment, and it leaves a scar on the economy. People don't recover from that for a number of years. It is a long run cost.
Okay, we better jump into listener questions. I've got a little bit too into this conversation. The most upvoted one is from Sean Hamilton. It says, do you think the budget announcement of a $350 one-off stimulus payment is actually making a difference to the economy given the steady pace of inflation and OCR rate rises? Really asking what will be the impact of that $350 the government is giving out to some people.
That's a good question. And again, I'm going to run the risk here of looking like the bad guy. I don't disagree. I 100% support targeted support to the people in our economy who are really, really struggling. And there are lots of those, lots more than there were before this pandemic, an absolute desperate need. However, I think a little bit questionable as to how targeted that policy was. If it's going to sort of capture 2 million people, and that's a relatively widespread spray of what's ultimately fiscal stimulus. And when you put more fiscal stimulus into an economy that's already facing capacity constraints that we've talked about, you're just going to bid up prices ultimately.
Yeah.
The big challenge for the government, of course, is getting that balance right, helping those who really, really need it while not providing more aggregate stimulus, or that ultimately, if they provide more stimulus, which they did do in budget, the Reserve
Yeah.
Bank is just going to have to make room for that by lifting interest rates higher than otherwise. So it means your
Yeah.
businesses and your households are paying for that through their debt.
Yeah.
So it's a tough one, but I think what it's going to do is probably boost inflation temporarily, so higher than otherwise inflation because of that. I think it's going to make a little bit of difference for a few people who are at the bottom. I would have much rather have seen more money go to the bottom and maybe trim the tops off that.
Yeah.
But of course, you're always going to hear individual anecdote where a person earning 70k is really, really struggling. But on the other hand, you've got a person earning 70k who has no mortgage, pays no rent, and owns 3 rental properties, getting money from
Yeah.
the government. It's just not targeted enough, and for my liking personally.
Yeah, yeah. So I think you've sort of got to what the listener was asking in terms of the government can hand out money and it might just force the official official cash rate to go up slightly more, and they're kind of working at odds against each other there. Somebody asks, is the world economy, not just New Zealand, but globally heading towards a recession, as you see people talk about on CNBC and that?
Yeah, I think a lot of these risks we've talked about for the New Zealand economy apply to the rest of the world. I think the Australian economy is, in similar territory as it tries to go to battle, as their central bank goes to battle with inflation. The Federal Reserve is doing battle with inflation. Lots of Asian central banks, so South Korea, etc., doing the same thing. Canada doing the same thing. Same thing in the UK. All high inflation. All looking at outsized OCR hikes or their equivalent of the OCR, and that makes that risk much higher. Add on top of that what's going on in China with their sort of COVID policy. That's hurting their activity. It's not good for their demand of our exports. Plenty of global risk out there. I think you can ultimately carve the global economy into 3 chunks: the US, China, and everyone else. And we're seeing sort of risks on all fronts.
Okay, so we're not alone in this situation. Here's a question we haven't discussed. Someone asks, how does the increase in minimum wage affect the economy?
Well, for those in a contemporaneous, like in an instant sense, who receive that bump to their income, are obviously very grateful. The caution with boosting wages sort of via regulation is that you can create unemployment. Obviously, we haven't seen that this cycle. Unemployment's very low, so filth. But at the same time, this isn't the stuff that makes sustainable wage growth. You achieve sustainable wage growth by lifting labor productivity, i.e., a business needs to have a larger residual by getting more out of its workers in order to divvy that up amongst its workers. If you take a business and force it to pay its workers more, there's a risk that they don't actually make up that anywhere else, and it just becomes a bigger cost, which can ultimately hinder productivity of that business because there's less left for them to invest in that very vital productivity enhancing capital that they need to do. So it's a complex scenario. We again need to set policy to protect people out there sort of towards the minimum wage, but it's not a sustainable source of medium-term wage growth. You achieve that by boosting productivity, and there's not a lot of policy, I think, that's boosting productivity at the moment. Businesses are now sort of probably looking at a bit of belt tightening, and that's not good for capital expenditure.
Right. It seems like the sort of thing that needs to be carefully timed, so that you're not just adding pressure on an economy that's already running at capacity.
100%. And if you put the increases in when the labour market's already tight, chances are businesses can absorb that. If you put the increases in when the labour market has a lot of slack, then chances are businesses cannot absorb that. So timing matters.
Okay. Yeah. Okay. Headline: Miles Workman says government should rush through minimum wage hikes right now.
I wouldn't go that far.
What else have we got here? Colin asks, our building consents are at record highs. However, expectations are that house prices will drop. How does that work? Will the planned construction drop off accordingly, or will we kind of build throughout the recession, even out of it?
Yeah, great question, Colin. So yes, you're right. Our consents are at a record high level. We look at a very good question in our ANZ Business Outlook survey. It asks residential or people who work in the residential construction industry where they think construction activity is going, and that's definitely turning downwards. So how do you reconcile those two things? Basically, if I look at the consents data, I do see that a lot of the recent growth in consents has been led by multi-unit dwellings. So
Okay.
that suggests to me that your sort of, typical freehold house is probably stagnating in terms of construction activity. But there have been changes made to legislation for intensification. I think that's now boosting multi-unit dwellings.
Yeah.
Hopefully they get built, but I think with interest rates going where they are, with building costs going where they are, there's a very significant risk that developers get stuck in between high costs to build and lower prices that they can sell at. That could see some of those consented projects scrapped. And I really wouldn't be surprised if some of those consented projects that we're seeing do ultimately, they don't get completed. They get scrapped before shovels are in the ground.
Yeah. Okay. I feel like the other question here is, would you say we're in a bear market now, or is it yet, or will it come? I suspect they're referring to the stock market. Do you have a view on that, or is that sort of outside of your wheelhouse?
Well, I mean, you can define a bear or a bull market, quite specifically. But I think this question's getting more at, is there, is it definite? Are we in this downwards trend for momentum, sort of,
Mhm.
versus 200-day moving average, or however you want to quantify? So I think there's possibly more to come if we think about interest rate
Mhm.
outlook. Um, Again, on our forecast with the 3.5% OCR, we are currently seeing market pricing above that, closer to the Reserve Bank's forecast of 4%.
Yeah.
And the way wholesale markets work is that the way market expectations function, that actually drives real interest rates or actual interest rates, nominal interest rates in the economy, suggesting that it's a pretty hard one to actually pin down in terms of where these drivers might stop, because ultimately it stops
Yeah.
where inflation expectations stop and where central banks have to stop hiking. So
Yeah.
if we're talking about a sustained momentum perspective, I think we're still in very much volatile times.
Mhm.
So it is a watch this space. In terms of equities, you make a good point, and if we want to make a comment on that, it's complicated by the fact that the retail platform for global equities is so much larger than it's ever been. It's much larger than it was during the GFC. And what I mean by that is it's platforms like Sharesies, where people are able to get into the market at a smaller quantum. But that small quantum aggregated over an entire population is very significant.
Yeah.
So it's not just trying to pick what traders are going to do, and sort of, if you imagine the Wolf of
Mhm.
Wall Street type world, it's also trying to pick now what households are thinking.
Yeah. Yeah. It's been very interesting, and you do see Sharesies users setting prices on some stocks on the NZX for sure. All right. Well, I think we actually have pretty much run out of time, Miles. But super appreciate you joining us. Really interesting thoughts, great insights. I feel more informed. I'm sure our readers do as well. Thank you so much for joining us.
No worries. Thanks for having me.
Pleasure. Next week, my colleague Francis Cook will be chatting with the CEO of Channel Infrastructure. Her name's Naomi James. There's a lot to talk about there. The company runs what used to be the Marsden Point oil refinery up north, but it has stopped operating as a refinery and is just becoming an import-only terminal, basically piping jet fuel straight to Auckland Airport, as well as some other things. So Francis is going to be talking about how that transition is going and what the future of the company looks like. Tune in to get the download on that. It'll be very good. Please use the link in the chat to register so you don't miss out and get a little notification. Again, eat your lunch over eat your lunch with us, I guess. Yeah. Please enjoy the rest of your week and stay safe.